Welcome to the Techno Fundamental Report for April the 2nd. Cash combined with courage in a time of crisis is priceless. Buffett agrees with me. Being in cash sometimes makes sense. If a train is coming at you on a track going 200 miles an hour and you're walking down that track, it might make sense, or it would make sense, to step off the track, let the train pass, and then get back on the track again. So we've been defensive since last October. We've been basically net sellers since last October, and we'll talk a little bit more about our indicators. I wanted to talk a minute about private equity, private credit. It's in the news quite a bit now. And the thing about private equity is that it's illiquid. I mean, if you're in the Blackstone or BlackRock or KKR programs, you can't get out of them. Now, Gerald Loeb writes somewhat about this in his book that was written in 1935. He says, there are some rules that hold, and my first is to buy only something that is quoted daily and can be bought and sold in an auction market daily. The greater the volume trading and the broader the market in particular security, the closer to a fair price at a given moment that security is likely to be. So if you get involved in these private deals, you're pretty much violating what Loeb says is a major rule. You don't want to get involved in things that you cannot get out of. If things change, you might have a disaster on your hands and you can't get out of it. Now, I wanted to talk a little bit about things that I have learned over the years that are the most important. And I listed about 20 things that I thought about, but let's just talk about a couple of them. Number one, you want to cut your losses quickly. If you're wrong on an investment and you've just made a mistake and you've realized it, don't become emotional and let your ego get in the way. Cut your losses quickly. Trying to predict the future is like trying to drive down a country road at night with no lights while looking out the back window. Predicting is a waste of time. You should trend follow. You let the market tell you what's going on. In other words, don't have an opinion. Your opinions are going to get you in trouble because the market is going to tell you what's going on and what's not going on. Now, one of the most important things that I think I've learned over the years is that you've got to think like an institutional investor. Now, I'm talking about these multi-billion-dollar funds that are out there driving the market. If you look at the volume figures, 85 to 90% of the volume on the exchanges is driven by the institutions. So you need to think like an institutional investor, and that has a lot to do with volume of trading. All right, let's take a look at the market, see how we're doing. Now, remember the follow-through day is where we get a higher close on day one of a rally attempt. Now, this is after a big decline like we've had, usually around 10% correction. So, FOMO, fear of missing out, how can we deal with that? So if you go with the follow-through day, there's a higher close on day one. So here's the low, here's the higher close. So this is the first day of the rally attempt. Now, we're actually in the second day now of the rally attempt. So let's continue here. So you go higher on the first day, followed by 2 days where the index does not fall below the low of day one. So we need to hold that low. On day 4 or later, a significant gain in price and volume confirms the follow-through day. So once we get 4 days, and even on the 4th day, if we get a robust rally on heavy volume or above average volume, that's going to tell you it's a follow-through day, and you might want to consider nibbling on something. So if we look at the follow-through day on the S&P, it's kind of the same thing as the NASDAQ. We got the low. We've got our first day of the rally attempt. Now we're in the second day of the rally attempt. Now, if we get to the aggression index, this is something we've talked about many times in the past. It's nothing more than a ratio where we're trying to figure out what the institutional investors are doing. Now, One of the things they do that is very important to understand, when they get defensive, they don't necessarily go to cash, because when you're managing billions of dollars, it's kind of difficult to do that, if not impossible. So what they do instead is they start shifting their portfolios into consumer staples, utilities, things that are very defensive. So what we're going to do here is we're going to take 5 aggression indexes that I've developed, and we're going to look for 3 out of 5 where the ratio gets above the lower moving average and the lower moving average turns up. So you could argue that this particular ratio is starting to do that. Now, I have to give kudos to this indicator because it gave us an early warning. When it broke below these moving averages and these moving averages turned down, it gave us an early warning that this market was in trouble because the institutions were shifting their portfolios. We got that around, it was in January. Around January the 10th, we started to get these readings. So this is an early warning system, and I'm not going to ignore it. I would recommend you don't ignore it either. Now, the second we're going to look at is where we're comparing it to low volatility stocks. And you can see we've gotten back above that lower moving average, but that lower moving average is continuing to go down. So I'm really not seeing much there. Now, this is the ARK Innovation Fund. This is a high growth ETF that is run by Kathy Wood. It had a fantastic year back in 21-22. However, we're not even above the lower moving average, so I would say this continues to be weak. Now here's the IBD 50 fund. This is 50 growth stocks identified by Investors Business Daily, and they have a fund. Well, you can see there's a lot of white space in here. We're really not making any progress on this particular fund. Momentum shares, which is high momentum stocks, above the lower, or right at the lower moving average, but the lower moving average continues to turn down. So the aggression index is certainly not giving a screaming buy signal, but it does look like things are starting to improve a little bit. So if you get the follow-through day on either the NASDAQ or the S&P, and then at the same time 3 out of 5 of the aggression index calculations are positive, you should consider nibbling a little bit if you have cash to invest. Now, we need to keep an eye on interest rates. Interest rates kind of have perked up here quite a bit with the oil scare and the inflation scare. We're above 0 on the power index, which is telling me the Fed's probably not planning on cutting interest rates now or possibly anytime soon, maybe later in the year. But this particular indicator is designed to tell us that the Federal Reserve is sitting on its hands. The one positive note here, this is a graph, a ratio, where I'm comparing small cap stocks to large cap Mag 7 type stocks. You can see that the Mag 7s have been outperforming the small caps for about 3 years. So it's been a very difficult period for growth stocks outside of the Mag 7. In other words, the other 493 have been basically underperforming the Mag 7. Well, everybody's calling them the miserable 7 now. But you can see there, this ratio as of the beginning of the year or in the fourth quarter of last year, we're seeing it bottom out and starting to turn up. So there looks like there's a switch taking place. Hopefully this lasts. Now, if you notice here, in the past we've had rallies that fail, rallies that fail. However, this rally seems to be making higher lows and higher highs. So keep an eye on the small caps. I think they're possibly going to enter a period of outperformance. Now, the primary trend, excuse me, the 200-day moving average has been violated. So the other thing to mention here is that as we look for those follow-through days, if you're below the 200-day moving average, there's kind of a possibility that that follow-through day is going to fail. Now, we want to get back above that 200-day moving average on both of these indexes. Price of oil through the roof. As of the most recent quote, we're at 101.38 per barrel on West Texas Intermediate. Just like interest rates, this is possibly a problem, or is a problem. The number of new lows on the New York Stock Exchange are too high. We want them below 40. So in conclusion, what I'm saying is the market is showing some signs of trying to put in a bottom here, But until we get that follow-through day and until we get improvement in the aggression index, as well as some other indicators, I would continue to stay cautious, maybe do a little bit of nibbling, but don't ignore your stop loss. You need to maintain your stop loss. So if you have any questions, please let me know. Thank you very much.